This is 30minutetrading.com. You can see this is the trade account at the moment. The trade has already had 2 tranches taken off the table, so we're in excess of £1,000 profit for the day. We have essentially we're trading gold and silver. We got into the trade because of this trade alert here. There's a number of indicators here which you can talk about on training courses and so on, but basically that trade alert there told us to get into the trade. We've got our stops underneath there, we stayed in the trade. We got another order that went in as it broke out above this level here, so we ended up with 5 tranches running. During this period here, we're outside having lunch with friends and basically just enjoying ourselves. Came back in again. We took some of the money off the table at that level there, 2 tranches off the table there. We've still got 3 tranches running. We've made over £1,000 today and it's still running on up. And that's how it works with the indicators. So this is how you trade using my proprietary indicators, Cato BBB indicator, which gives you the trade alerts, tells you when to trade and which direction to trade, and can help you make money like this. It's rising very nicely. We'll leave it away and go out and enjoy the evening and let it carry on making money. Hello and welcome. My name's John Cato. One of the things I've got to talk to you about first then, because you're interested in risk management, is risk management. Now, risk management is one of those things that many people in the trading courses and so on don't really teach you very much. I remember going along to a trading course where they taught me that 3% was the amount you should risk on any given trade. I'm here to tell you that that's far too much. Now I'll explain to you why. Okay, here we go. So let's talk about some simple facts about probability. When you're trading, the only thing you can control is your risk. If you were winning 50% of the time and losing 50% of the time, in 10 trades you will lose 3.3 times in a row. That's this number here. Clearly that means 3 times or 4 times in a row. And if you're trading 100 trades with a 50% win ratio, you will lose 6.6 times in a row. Obviously you can't be 6.6 again, so that's 6 or 7 times in a row. This calculates how much you require as a profit to recover from losses if you have that, and that is a fact. You will get that if you're having a 50% win ratio. Therefore, let's just have a look. Suppose you are risking 5% on any given trade. So you've got a $10,000 pot and you've got a 5% risk. So you're risking $500 on any given trade. If you did that, then you will, at some point within 10 trades, need to get 22% back to get back to break even. And in 100 trades, you'll need 43% to get back to break even. That's clearly not acceptable. So you have to reduce your risk amount down. Now, you will find that a lot of people suggest that you risk 3%, and you'll see here that you still need 12.96% after 10 trades to get back to break even, and 23% to get back to break even after 100 trades. So that is just the maths of the situation. That's the rules of the game. So how long are you going to be able to take that pain of being down that far? So the next question is, well, what is a better risk? And if you put in 1% in there, you will see after 10 trades and you manage your risk correctly, you can never be down more than 4%. And if you take it on 100 trades, it's 7.29%, and 1,000 trades, it's 10%. Now you might say that's not very adventurous, and I agree, it's not. But the name of the game is not being adventurous. The name of the game is making money. If you trade in this way, with risking only 1%, you will always be in control of your money. And your target, of course, is to win more than 50% of the time. That's where you have to get the edge, and I will talk to you about the edge right now. The first part of having the edge is to make sure you trade the right asset. Now, you can see here, this is a spreadsheet. It's taken quite a long time to develop, and essentially it gives you an overview of all of the major assets and allows you to put in your own personal other assets as well. Now let's just take a few examples. Okay, here we have, for example, at this particular point in time, which was a little while ago, gold was trading at 1234 as it happens, and it has a weekly rating in terms of bull bearishness of -13, daily -14.75, 4 hour -14, hour 8.5, 30-minute 9.75, and it has an inherent risk-reward ratio 61, 21, and so on. So that would be a good asset to trade from the point of view of its inherent risk-reward ratio, though as you can see down here there's one with a much better inherent risk-reward ratio, which is the DAX. But it would have been a bad one to trade because it is red, 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 green, green. So we have conflict across these different times. So what we're looking for is something without conflict. And here we can see some things here which are without conflict. For example, the S&P 500, and that's without conflict, but its inherent risk-reward ratio isn't so strong. So what you're looking to do is to find assets that are strong, that's to say green here and green here. But most importantly, they must be in the lower time scales because they lead. So everything all the way down through here must all be consistent. So here, for example, Euro stocks at this particular point in time was all consistent. But it wasn't so good from a risk-reward ratio, from an inherent risk-reward ratio. So those are all decisions you have to make when choosing to trade a particular asset. And you can see that there are various assets through here. For example, at this particular point in time, the dollar yen, the US dollar JPY, the dollar yen, was green, 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 and then neutral on the 4 hour and neutral on the 30-minute. But both of those are positive neutrals, and the risk-reward ratio is very strong. So actually on this particular day, the dollar yen was probably the right asset to be looking to trade. And since you're focusing your attention on something which has got inherent good, strong risk-reward ratios and is consistent in terms of its direction and trend, you have a potential positive outcome. And that's what it's all about. It's all about probability and putting everything in your favor. So what's the next part of managing risk? I'll show you. As you'll have noticed from the last page that we were on, the market overview page, we're looking to trade the dollar yen long. And so we have our $10,000 in the account. We've got our risk of 1%. We're going to trade the dollar yen. We're looking at its spread, which happens to be 1.5. This is going to be our target entry price. This is going to be our technical stop. This is going to be our first target and our second target. This is how much margin actually this particular account requires. And this calculator tells you that your maximum risk per pip will be 7 units, $7 per pip of movement. If you trade like that, then you will be within your risk constraints and you'll be trading much more safely. And if you want to be even more prudent, of course, you can decide to trade with a smaller risk per pip, and this puts in the details of what you're actually deciding to do. It also tells you a whole load of other information which I'll explain on some other video sometime for you. But for example, here it tells you that if you did that, you'd be controlling $62,000 worth of asset. If you traded with 3 units per pip, you'd be controlling $25,000 worth of asset. and it gives you an idea about exactly how many risk pips and target pips you're going to have. So your risk pips are those, these are your target pips, and it tells you also how much you're likely to make. So if we come down through here, we can see the other details. In this section here, we can say the reward value would be $50 for that. Reward value 2 would be $222. Or if we traded with the original objective setting of 7, our first reward value would be $122 and our second reward value would be $540. And in terms of the account value, because we've got $10,000 in the account, that would give a return of 5.4% off that one trade. So, and if we just hit the first target, it would give a return of 1.23% off of just that one trade. So that would be a good trade to make, and is good risk reward ratios, and you could increase your account balance by 5.4% out of one trade, which if you did just one trade in a week, that would be a very good return on your capital. So that's the basics of risk management, and let's move on to the next bit about putting everything in your favor. So the other question then is, okay, we now know what we're going to do with our money in terms of our money management and risk management. The question is, how do we make money? There's an old saying, it says, the trend is your friend. And, well, what does that mean? What is the trend? Now, when I first started getting into this, I thought I really understood the trend, and then I found that I didn't. And then I found it was actually confusing. In fact, most people don't understand the trend. It's actually very simple and straightforward, and at the same time it's complicated by the fact there's more than one trend. There's the major trend, then there's the medium-term trend, and then there's the short-term trend. And all of them keep moving around, and sometimes they're in conflict with one another. And the question is, what do you do? How do you know which way you should be trading? And this puzzle consumed me for a while, because I thought I understood it, and then I decided I didn't. And then I decided, well, obviously the thing to do, since I've been doing software engineering for about 30 or 40 years or more, 1973, you work it out, I thought, well, the obvious thing to do is to write an algorithm that will go into the details using the price and various other ways of looking at it to work out what the trend is. But first, before I go into that, let me just explain to you why it's a complicated issue and why traders do find it a little bit difficult, and then I'll show you what I've done to resolve that problem. Right, so let's look at trend and understand the trend is your friend. Well, here we go. Let's look at this. This is called the pound GBP USD, the pound dollar. Currently, we're looking at the monthly chart. Now, the monthly chart means that we're looking at monthly candles. For those of you who've not seen my candles training course, then candles are essentially these objects here. This is a candle, which is an up candle, and then this is a down candle, and then this is an up candle, and it represents the high, the low, the open and the close. I'm going to tell you very briefly what the high, the low and the open and the close is. So let's take this big white candle here that I'm pointing at. The low is the bottom of what's this called. This thing here is called a wick. This is called a wick, this little green thing here poking down. So as low as it went was there, and then it started there, and then it went all the way up to the top as high as that, and then it closed there. So this represents a whole month of traders trading, and it says it opened at this point and it closed at this point. It had a small upper wick and a small lower wick. That's a candle. Okay, so now we can see here we have candles moving up, candles moving down, candles moving across, candles moving up,
candles moving down. Which way are we going? What is the trend? And one way of interpreting the trend is to look at highs and lows. So here is what's called a low, and here is what's called a high. Now you're looking for higher highs or lower lows. Here we've got a low which is lower than this one, so that's a lower low, and that means, by conventional wisdom, that means we are going down. So that means we're looking for a trade to the downside, but it didn't, it came up. Now this, remember, was a high, so this is a higher high than this, but this is a lower low than that. So we're kind of going sideways, we're not sure what we're doing. And clearly the market also thinks it's not sure what it's doing either, because it's coming back down again. You have to make sense of this as a trader. So how do you make sense of this? One way of making sense of it is looking at it at multiple different time scales. So looking at different time scales means we look at the week candles. On weekly candles we can see, well, it was moving up in general, but actually not in a straight line. It was going up, and then it was coming down, and then it was going up, and then it was coming down, and now it's coming down and down and down. So now what are we doing? Well, another way of looking at it is to look at the daily candles. And the daily candles are showing down and up here, and then down, and then are we going back up again? Well, maybe. So then we have to look at something closer still, and we go into 4-hour candles, and we can see we're going sideways, down, sideways, up, sideways. Now what? So we can look at the 1-hour candles. Well, on the 1-hour point of view, we're clearly up and a bit of down, up, down, up, and we're taking the higher lows and lower highs and so on. So here's a high, this was clearly a low down here. This is a low, which is a higher low than this one. This is a high, which is a higher high than this one. And this is a higher low than this one. And this is a higher high than this one. So by conventional wisdom, that is now going up. So let's have a look. From the 1-hour point of view, come back there, we're going up. From the 4-hour point of view, we're not sure, we're kind of coming down. From the daily point of view, we're going down, but not clearly, because we were down here, then we've gone up, down here. This might be coming back up again, I don't know. From a weekly point of view, well, we're clearly going down. From a monthly point of view, well, we're probably going up. So you have to be able to make sense of all of this when you're trading. And one way of also making sense of it is to put things called moving averages onto the chart. So I've just put a moving average onto this chart, and this is a 200 period moving average. If you listen to the commentators on the news forecasts and things like that, you will often hear people say it has hit the 200 moving average. And they think that is absolutely significant, crucial, and all the rest of it. And from a monthly point of view, with the 200 moving average, you can see we are pretty much going sideways. It hit the moving average here, but then it went over it, and it came over top of it, and then it hit it and came back down below it. And all of this was all below it. So we know, in some sense, we're kind of below the 200 moving average. So is that all there is to it? Well, no, not really. What they often also talk about is something called the 50 moving average. Let's put that on the chart. So I've now put the 50 moving average on. Now, I'm not sure if I explained what a moving average is properly. Essentially, a moving average is an average of the last however many number of candles. And a candle is either a monthly candle, a weekly candle, daily candle, 4-hourly candle, and so on. So it's how many periods it is. Each one of those is a period. Now this is a 50 moving average, and that means it's counting 50 periods backwards, and it's taking the average of all of those, and it's saying this is the average of the 50. And again, people say, well, when it hits the 50, it will bounce. And sometimes that's true and sometimes it's not. So it's not by itself a trading discipline that you can rely on. So here we have it hitting the 50 there, but here it hit the 50 and went straight past it. Here it hit the 50 and went straight past it. So it's definitely not clear. Here it's hit the 50 and people say it would bounce from that, but it didn't, it jumped over the top of it. So you can't rely on that as being a trading system by itself, but you do need to know roughly what you might expect. So from this point of view, we might expect, since it's over this 50 and below the 200, that it might stay in this period here. But as you can see, that's not always true either. It was in this period between the lines there, and then it came above the lines. You have to make sense of that too. So moving averages are one thing, but they're not enough. And highs and lows are one thing, but they're not enough. So you have to have more information than that. So once again, I thought, well, I'll write some algorithms, and the algorithms will tell us where we are and what we need to think about when we're trading this. So I created a thing called the Cato Bull Bear Butterfly Indicator. And it's basically an indicator which takes a huge amount of information, does a calculation on it, does it all in live real time, and shows you where you stand. Essentially, this works like this. This blue line will be rising when price is rising. So here it's beginning to turn and rise, and this gives you a clue that the price is beginning to move back up again slightly before it actually does it. You can see it gives you the indication just before it does it. And this red line here tells you that if it's below that, you're looking to go down. So you're looking for trades down. And if you're above that green line, you're looking for trades up. So we're looking for trades up. And if you're in the middle, you're in what's called the butterfly zone. I call it the butterfly zone because it's the zone where the market does not know quite what to do. It's like a butterfly. It will flip from one to the other, and you can expect the unexpected as a butterfly. What you can do, though, is you can see that from this blue line, which way the blue line is going. And it's going up through there, and you can see the price is moving up. So whenever you see that moving up, you must expect a price movement to the up side, and whenever you see that moving down, you must expect a movement to the down side. And when it's below the dotted line, that is the line, above or below the line, when it's below the line, you should be looking primarily for trades to the down side, and when it's above the line, you should be looking primarily for trades above the line or up. So this one indicator alone will keep you out of a lot of trouble if you just pay attention to what it's doing, whether it's pointing upwards or downwards, whether it's above the line or below the line, and when it's above green or below red. Will give you a huge amount of information you wouldn't otherwise have. Now we can then use that to go in on different timescales as we've already been looking. So you can see for any given timescale what you might expect. So for the weekly, you can see that it is in the butterfly zone and it is coming down but leveling out. For the daily, you can see that it is down below 10. Look, that's in the bearish zone, the red zone, that's called bearish, below the line, below the red line as well. But it is beginning to flatten out and potentially turn back up again. However, at the moment, we're really looking for trades only going down. But from a 4-hourly point of view, you can see it's sloping up. And it's clearly sloping up, but it is still below -7.5. It's therefore still going down, bearish, so we're still looking for trades to the down side. And when we're looking at the H1, that's the 1-hour chart, we can see we have conflict because we have the line moving up, down, up, and then it's above that green line. So from a 1-hour point of view, we're looking for trades going up. So part of the training is about understanding what you're going to do with these conflicts arising. Here clearly, from a 1 hour point of view, we are going up. And you know, changes always occur at the smallest level first. Changes like this are like the butterfly's wings in Japan, changing and creating a tsunami somewhere else. You have a small change at the 1 hour level, and if it continues to proceed at the 1 hour level, that could initiate a change at all of the other levels. So that's really what you've got to watch out for. Anyway, that is the Cato Bull Bear Butterfly Indicator, which will keep you out of a lot of trouble if you just pay attention to it. What you have to do is look at multiple timescales down to the finest level of granularity that you personally are interested in trading, and that's the level at which you make your final decisions. You want alignment across a number of different levels, and you want to achieve that by making sure that the Cato Bull Bear Butterfly Indicator is in agreement across more than one level, and certainly across the two lower levels that you're planning to trade. So there you go, I hope that helps, and let's move on to the next subject we wanted to talk about. So what we've just talked about really is the medium-term trend, and how you understand what the medium-term trend is. So this is using the Cato Bull Bear Butterfly Indicator. Cato is of course my name, Cato, and a friend of mine once said it ought to stand for something, so I decided it stands for Cash to Order. C-A-T-O, Cash to Order. Now clearly I can't make any promises. I can't tell how you're going to trade or what you're going to do, and I can't tell anything about you really. I mean, I haven't met you, much as I'd love to. However, what I can tell you is that if you bring the ideas that I bring to the table with the Cato indicators, that you will trade more successfully. You have to be very, very disciplined, you have to be very, very careful, and you have to do the money management, of course, as we've already talked about. Now let's talk a little bit more about the next level. Let's look at the shorter term trend. Now I've created another indicator for this, and this is called the Litmus test. And the Litmus test goes in and gives you a finer degree of focus, I suppose. Focus on where it is that you need to be paying your attention. So we now know where it's going in terms of the medium term. We've got a good idea of what it's doing. We know what we want to do. Now we want to look at the Litmus test and decide whether now, at this moment, is a good time to do it at any given time scale that we might be looking at. So let's have a look at that. So here we are back at the pound-dollar chart that we were just looking at, and we're currently on the 1 hour chart. For the purposes of the exercise, it doesn't really matter much which chart we're looking at. So we'll go with this. Now then, I'm going to add the Litmus test on. So it's the Cato Litmus test. So here we go. I'm going to add this on now. And you can see that I've added this indicator down here, the Cato Litmus test. And this has a blue line with these two dotted lines here, and this is an indicator where when it's between the two dotted lines, it in itself is in butterfly. When it's right in the middle here, it's totally undecided. When it's either side of the middle, but still inside these two lines here, it is tending towards going down or tending towards going up. And it gives you a potentially earlier indicator about what's going on. Let's see how it works. Along here we can see it's up, so there's no question that when the Litmus test is up, you're looking for trades to the upside only on the shorter term. So here we are down, bear, but pulling up with this. But before that started to pull up, you can see Litmus test was already showing that you should be looking for trades to the upside. Over here, it suddenly flips just there, and it flips from being up to moving down, which is giving you the indication that this is stopped going up and is now coming down, as you can see it did. And then it's running along down here in butterfly, so it doesn't know what it's going to do. It could flip either way. and then it moves back to there, which is the first indication here that you're going up, providing the chances for a trade to the upside. Now we are up, and at this point here it suddenly flips down, bing, and down it goes. And at this point here it moves back up, and so now we're looking for trades up. But now we're looking for trades coming down here, okay, as it's turning around this point here. So you can see that the litmus test is another tool to help you stay out of trouble when you're trading. You must pay attention to what the litmus test is telling you. At the moment it's telling you, from the bull bear butterfly, it's telling you we're going long. And for every indication we can see here, we're going long. But litmus test is saying don't go long at the moment. So I hope that makes that very clear to you. The litmus test is another tool in your kit bag where you need to identify what you're going to do based on the shorter term, what shall I call it, the shorter term energy in the market. And the litmus test is another really good tool to help you find out what's going on. It applies across all timescales and all financial assets because it actually pays attention to what's going on within what we call the price action. The price action being the price movement in relationship to time. From the 4-hour point of view, the bull bear butterfly is bear, but litmus test is saying you should only be looking for trades to the upside, long. And when you're looking at the daily, you can see that the daily chart is down on the Cato bull bear butterfly indicator. It is clearly bear, but litmus test is saying we're butterfly, we're undecided. So a combination of those indicators there will give you great insight into what you should be considering in terms of which way the market is going to move next. So there you are, that's that, and we'll move on to the next one. Okay, so there we have it. Now, what else do we look at in terms of trading? What other things can we consider? We've considered the overall trend, or the medium-term trend. We've concerned ourselves with the shorter-term trend and how they work together and how we might interpret them. Now, you might think that that covers it all, but it doesn't. Typically within trading gives you challenges to consider. And there are no guarantees. This is a risky business, so you have to understand the risk and to make an assessment for yourself what you're going to do about that. So the next level is to look at what I think of as being momentum. There are various momentum indicators out there, and they all do the job in one way or another. And nevertheless, I found that not one of them did it the way that I wanted to give me earlier heads up on what's going on. So I created two momentum indicators, and they are the M-Trader and the M-Trader 3. So here we are again on the pound dollar. We're looking at the daily chart where we left it a minute ago. Okay, here we are on the daily, and I've just added onto this the M-Trader 3, the Cato M-Trader 3, and this is an indicator which gives us an idea about which way we should be trading as well. You can see here that the M-Trader 3 went from below to above here. So Litmus had moved up into the butterfly zone, but M-Trader 3 had said we're looking for long trades. That's up, long trades, up trades from this point onwards. And indeed, that would have suited us very well, because if we had traded long from then on, we could have made some money as it rose to here. And at this point here, it says we're looking for short trades. So here we're looking for trades going down. And here you can see that from this point on, indeed, it went down. And in this case, the litmus test was showing down as well. So we had all of those in agreement that we were looking for a trade in that direction. Now you can see litmus test has come into the butterfly zone. The bull bear butterfly is still bear, and M-Trader 3 is still bear. So from that point of view, we're still looking for trades to the downside. That's short trades. MTrader 3 is another indicator which will keep you out of a lot of trouble if you pay attention to it. And if you trade against MTrader 3, you have to know consciously you are trading against MTrader 3, and therefore the probabilities are against you. So always be careful with what you're doing and how you use your trading decisions. But a combination of the bull bear butterfly indicator, the litmus test, and MTrader 3 will help you a great deal. But as ever with trading, that's not all. So let's look at the MTrader. The MTrader is another indicator like the MTrader 3 indicator, and it operates on a slightly tighter time scale. It gets in there a little bit earlier. Not always. It all depends on what's happening with the price action as to whether or not it does, but it often will, and it's another indicator that it's worthwhile having in your kit bag to look at and understand how you would choose to trade. So now, as you can see, here we are on the daily chart for the pound dollar, and I have added the MTrader onto the chart. This is the gold line down at the bottom, and this is another indicator that I've written and coded through many years of research and consideration, and it gives you the early heads up about what might be going to happen. There are never any promises with trading, as I said to you before. Risk management is one of your major things, but also understanding what it is going to do or might be likely to do is something which is also very important. I'm going to point around on the chart here for you. You can see the MTrader was down here, and it moved upwards at about the same time that the litmus test moved to neutral, that's butterfly. But at this point in time, the bull bear butterfly was still down. So to all intents and purposes, through everything that anybody else might see, this is still going down. But the MTrader showed us the potential for a trade to the upside. And indeed, we had the trade to the upside signaled by the MTrader gold line. You can see here it dipped down and then dipped back up again. This dip down was caused when it came back from these highs here and back to here, and it was uncertain about what might happen next. But then this here, it pipped back up again, saying we're going back up again. In the meantime, as you can see, the MTrader 3 is holding green up all the way through this period, and in fact doesn't turn down until there. But MTrader here kicked down at this level here, saying after this we're going down, and indeed it pinpointed it more accurately, as you can see, than the MTrader 3. And it's another tool in the kit bag, really. It's another one of those things that I trust would help you making trading decisions in a way which is has more information for you, is more informed. But you can see how they work, and you can see what happens, and you can see how accurate they tend to be. Even if we look at smaller time scales, and we look in here at a smaller time scale, you can see that at this point there, the MTrader said we're going up, and indeed we went up. So here it said we're going down, and we came down. Here this MTrader 3 said we're wanting to look for trades going down all the way through this period, from there all the way through there. And here it says we're looking for trades going up through this period here. So you can see how accurate it seems to pinpoint what's going on. And it does it all in live time, in real time, as we're watching right now. It's making those decisions. You can see that MTrader has just ticked down, but this candle isn't finished yet. It's not finished. It's still trading. It's still moving up and down. It's jiggling around, and this hasn't finished yet. So we can't make any decisions until something is finished. The last thing that finished was there, saying we're going up. And you can see, in fact, we did go up for a while before it came back down again. So had you even traded then on the basis of what this was saying with this, you could have made a little bit of money here before it came back, and you may have traded to break even, or you made a bit of money in the bank. Over here, if you'd taken trades from this level here with confirmation there, you could have put this amount of money into your bank. So it's a question of trading with the information that you can glean, and using, if you want to, using my indicators, and using proper risk management, so that every time you trade, you're managing the risk. You're managing the trades to the upside, and you're managing trades to the downside, and you're managing the risk. So that's the MTrader 3 and the MTrader. Now you might think that's everything you need, and to some extent it is, but of course that's not the whole story. Things happen at the price action level a lot earlier than that. So you might have guessed, I've written another piece of software that gives me the heads up even earlier, to be used in conjunction with all of the other indicators, so that you only use it when it's supporting and supported by the other indicators. It gives you an indication earlier still, quite often. Not always, sometimes it's about the same time. So we will see by looking at the charts again. I'm going to add on to this chart now something called the S-Trader. And this is about the smaller, finer grained strength. It tells you when the bulls and the bears are coming in or out of the market, and it shows you more clearly what's happening. It's almost like watching a tug of war. You can tell when one side or the other is moving. It's that like little line in the sand where it's going. And this gives you the heads up really early on about whether something's going to happen or not, or potentially going to happen or not. So I commend you to have a look at this one as well. So let's have a look at the charts now. So I'm now looking at the chart over here, and you can see what's going on with a smaller time scale. And S-Trader gives you the minor tug of war that's going on. What's happening, what's happening, what's happening. And you can see that on this chart here, which is the 4-hour chart on the pound dollar, we have a tug of war going on. This is a tug of war. But every time it moves, it gives you an idea that the bulls or the bears have control. For example, here it's showing that the bulls had control because it moved to the upside, and that was a bull move up here. So here it's moving along, and then it comes down again, and here it's saying that the bears have control. So the bears have control, and it tells us that the bears have control earlier than the MTrader or the MTrader 3. So it tells us at this point, watch out, the bears have control, or opportunity, the bears have control. And this would mean we have the early opportunity of a potential trade to this side, to the downside, coming down this way. That is 197, 200 pip move, signalled by here the S-Trader getting in early. And that MTrader 3 could have kept us in the trade all the way through to somewhere over here. But you can see that the MTrader might have told us to get out of the trade at this point here. So we would have made a trade potentially from there to there, which is, there we are, that's correct. So about 197 pips. And if you think that you're trading, whatever you're trading, whether you're trading, should we say, a dollar for every pip, or a pound for every pip, or maybe maybe a euro for every pip, or something like that, that represents 197 pounds or dollars or euros, and depending on how much money you have in your account, of course, then you might have been trading $2 for a pip, or 3 or 5 or 10 or something. Now if it was $10 a pip, that would represent $1,970 or 1,970 pounds or 1,970 euros. And you can see that this would be something that might be a useful piece of information to have and make money out of. So this is why I'm ever so pleased with my software. I'm perhaps I'm over the moon by it. Really, it's very good, isn't it? And it's something I thought, well, I could keep it to myself, or I could put it out there and see if anybody else would find it interesting. And it's one of those things which is also educational. If you look at it, it's an educational tool, because every time you study the charts using my software, the Cato indicators, you learn something about how the bulls and the bears are playing out within themselves, what's going on, which way the trend is moving, what's happening. And you can see early indications, and you get to be able to spot what's going on and learn from my indicators about what's going on. So it's an educational tool for you in your trading journey and how you might make money. And it will work on forex, and it works on indices, and it works on commodities, and it also works on stocks as well. So if you've got a platform which is a broker which is offering you any one of those, this system, because it looks at the price action, that's the underlying psychology of what's happening, then it'll work for you. It'll work for you to educate you and show you what the probabilities are. And at the end of the day, what you're doing when you're trading is trading probabilities and managing risk. If you haven't got the risk management component in place as well, then you're missing a trick here.
Okay, so putting all of this lot together, let's have a look and see what kind of trade results one can achieve using this system and the indicators. So let's go and have a look at the screen, and we will see that over here we had the very first trade of the day on the 5th actually lost money, and then the second trade of the day made $59, and the third trade of the day made $332. That was the pound yen, and then the US dollar yen made $194, and then the euro pound, that made $191, and a trade against the DAX, the German index, that made $119, and a trade against the French index, that's the CAC, that made $188, and then a trade against the Dow Jones, that made $194, and a trade against the UK index, that made $207, and the final trade was against the Hong Kong index, and that made $3.90. And I closed off the waiting stop on the US dollar yen. This was made on account with approximately $42,000 in the account. It was 10 trades, it was one loss, and it made $1,087.15, $1,087.15. Right, so let's have a look at the rest of this, put it all together. Okay, so let's now have a look at what those indicators were saying to us on the trades that I just showed you. If we look at the pound yen, you can see the indicators are all set up. The litmus test is down, the bull bear butterfly is down, and the M trader is down all the way through this period here. You can see it all like it's laid out like a map. And then when the S trader signal, that's the red one at the very bottom, kicks down, that's the indication that the bulls and bears have changed their power ratio, and the bears have control. That's the ones that are going to take it down. So we're looking for a trade going down, which is selling the pound yen. And indeed that's what we did, and we took the money off the table as a result of the trade going down, as predicted by the momentum between the bulls and the bears, and the fact that the M trader momentum was pointing down, and litmus test was down, and the bull bear butterfly was down. So it's all about discipline. Be very, very disciplined. They're all pointing down. That makes the trade. This trade was made on a 4-hour chart, which means basically you only need to look at the chart every 4 hours. Any more frequently than that is unnecessary. You just turn up, look at the chart, make a decision, make the trade, and put all the appropriate stop losses on and the targets and so on, as discussed in the risk management and money management video, and that'll do it all for you. So now let's just have a look at the dollar yen, another trade that made money, and we can see the indicators here. They're set up slightly differently, and therefore this is a slightly more risky trade. What we can see is that the trade had been moving up and then changed to move its way down. Now the S trader again signaled the way, and it was conjoined with the M trader as well. That's the yellow one, the gold line. Above that you can see Litmus test has actually moved to 0, which is butterfly, and the bull bear butterfly indicator was trending down. So from a high but trending down. This is a reversal trade, it's not a trend trade. This makes it riskier, but still the signals are there to tell you what to do. And this trade again made money. Oh, and the two things you might notice on this is presenting the information as a bar chart, not a candle chart. In practice it comes to exactly the same thing, so it comes down to a personal preference. At any given time, whether you prefer the slimmer, cleaner lines of a bar chart or whether you want the candle chart, the way you interpret them is exactly the same. And the other thing you might notice on this particular chart as well is right down at the very bottom underneath the S trader indicator, I've added a thing called ATR, that's average true range, and that is a way to get a handle on where stops and targets are, in addition to any other ways you might think about it. On training courses and webinars and stuff, I'm very happy to explain to you in full detail all the different ways in which you can do it. Not enough time on this video. Now we move on to the euro pound. This again was on the 4-hour chart. This was a little bit of a cheeky little trade in a way. If you look at the chart, you can see that you've got a big rise up and then a consolidation period. Then we have a green candle, which actually was indicated by the S trader indicator, you can see down the bottom. That was saying long. The M trader indicator, the gold one, was saying short, so that was conflict. The one above, the M trader 3, was saying long, and Litmus test was saying butterfly, and the bull bear butterfly was saying short. So really we were looking for shorts in principle, but we're also looking at the situation that this is a bullish formation with the pole going up and the consolidation area. So we've got a bullish formation. So if we could take a trade going bullish from here, we might expect it to move up some distance from there, especially if it's rejecting the bearish nature of it. So anyway, the trade was put on based on the indicator of that bullish alert on the S trader. All the specification for where the target was and everything else was basically defined in the system, and the trade went straight to the target after it broke out above that level, went straight to target and banked the money. It then came back down again, but that didn't matter because we put the money in the bank. And then we're looking at the German index, the DAX. It's a great index to trade if you're into trading indices. It's actually excellent risk-reward ratio, and you could make a living just trading the DAX if you wanted to. Anyway, here we are. This is the DAX. You can see that all of the indicators were pushing down, and we've got Litmus test down, we've got the M trader 3 down, we've got the M trader, that's the gold one, down, and we've got the S trader down. Now this trade actually activated after the 2 candles that you can see there. When I got up in the morning, I could see that it's actually moving strongly upwards, but the indicators had indicated that a short was more probable than a trade to the long side, and overall the market was bear. As we can look at the bull bear butterfly indicator, that was below the 0 line. That means it's bear, and so the trade was put on, and I put all the settings on it to target profit and all that sort of thing. And then I actually, for all of these trades, I put all the trades on, and then I had to go out for a meeting, which I spent 3 hours at the meeting, and when I came back, a number of them had actually already put the money in the bank. So that's what I love about trading like this. You can make money even if you're not in front of the terminal and not in front of the computer, so that's brilliant. Anyway, I'm going to talk to you now about the alerts, because one of the absolutely magic things that I've done with this system now is to put alerts on it, which will give you details of what suggested stops are, suggested targets are, what the risk is, what the inherent risk is, and what sort of things you should do to trade it. And so now with the M-Trader, the M-Trader 3 and the S-Trader, we have separate alerts coming out on any time period that you're interested in watching, and it will tell you what asset you're going to be looking at trading, what time period the signal has been coming from, whether it's a buy or sell, how much to buy or sell depending on your pot size, where it will never risk more than the suggested risk of less than 1% per trade, and it tells you exactly what your entry price is, what your stop price is, what your first target is, and what your second target is. It also tells you what the spread is, what the average trading range is, what the inherent risk reward is, and what the reward profit is. With wheat, it's the 240, that's the 4-hour candle. It tells you everything about it to make that trade. The entry price, how much to risk on the trade, what the target is, and absolutely everything. There's the daily on the FTSE 100, and again the copper, which is actually a trade that we made and made money out of. That was the 4-hour copper chart. Tells you how much to sell, what entry price, and so on. The Australian index, that's the 4-hour chart, and it says selling the 4-hour chart, gives you targets for first piece of profit and second piece of profit. There's the French CAC. We actually made that trade. It put money in the account. That one tells you exactly how much to trade and exactly what your entry is and exactly what your targets are, and that's exactly what it did. We got the US 240, that's the 4-hour chart. We did actually put that trade on the chart as we expected and as we planned. That also put money in the bank. The US dollar yen, exactly, that's the 4-hour chart, and that tells you exactly how much to risk and exactly when to trade and how much to trade and where to take the profit, and we did all that and it put the money in the bank. The pound Aussie, that was another optional trade there. I don't think that activated. Then we also have trade alerts for the euro dollar coming up here, New Zealand dollar, all of these kicking off at 8 o'clock GMT. You can see loads and loads and loads of trade alerts. You've got so many all flagged up, and you don't need to look at anything that's not relevant. You only look at stuff that makes money. So it's just trades all over the place here. Look, even the Hong Kong one, we didn't make much money on that one. That was the one we only made $3.90 or so out of, but the rest of them were pretty good. There's the pound yen. First signal was actually a long before we ended up with a sell signal, and the sell signal we made money. That came up a bit later on in the day. So there's the DAX 4-hour sell, so we put that order on. That one put money in the bank very nicely. DAX is a really good index to trade. So as you can see, many alerts coming up all the time when you're trading with this signal. So you put onto the chart what you actually want to actually watch, and the system will come up and tell you what the options are for you. Full details of how to use this, of course, is in the training and webinars and so forth. And so I'm going to ask you now, what do you think that's worth? I mean, what is it worth to you? Given how much money you potentially could make out of it, what do you think it's worth? Give you a minute's thinking time about that, really. Well, I'll tell you what, I've got an offer for you right now, because I actually want to get some people using it, and I want to give you a chance to use it. And I want you to actually find out for yourself that it is going to make you money. So I'm going to make you an offer. It's a really simple offer. All you have to do is pay £1, £1 UK pound, and you can use it for a month. And it has a full refund available for you. If you don't like paying me £1, you can always claim the refund and have it back. And if that's what you want, there's no questions asked, you can do that. And the thing is, this is a monthly amount of money that you can pay for it. So you pay £1 to get onto the system. You use it for a month. You talk to me about anything you want during that month. We can even have Skype calls or anything like that. And at the end of the month, the price would go to £67 a month. Now, I think you will agree with me that you will make £67 a month at least out of using the system, so it's worth your while. But since you've never used it and you don't know, and we haven't had proper conversations one-to-one, I think it's only fair that you have it for £1. That's all it is, £1. And then we'll take the relationship on from there. You either make money, in which case you carry on and you subscribe and carry on subscribing, or you don't make money, you're not happy, you don't end up trading at all, you just decide that maybe it's not for you or whatever else like that, and that's fine. Any reason at all, whatever it is, you can have your £1 back. And even on the first month that you actually paid your £67, you sign up for that, go roll on to that. If at the end of that month where you've paid £67 you haven't got £67 back, all you have to say to me, John, it didn't work out for me, and I'll give you that £67 back as well. So it's no risk at all in terms of you taking on the software. Of course, it's up to you, the trading. That I can't be sitting there actually pushing the buttons for you. So I can't be responsible for the way in which you push buttons. I can't be responsible for the trades itself. But all I can tell you, I've got this magic piece of software that will be absolutely blow your mind, and all it is £1. So sign up for it. Just get onto the mailing list. Tell me you want it, then we'll have a conversation about it, and see if you'd like to. Well, see if you'd like to actually take it forwards. And just sign up for it. Let me know, and we'll take it from there. Okay, so there it is, £1, and can't say better than that. I'll see you on the other side. Just sign out. Bye for now. Wishing you happy trading.